The Federal Deposit Insurance Corporation recently announced the collapse of U.S.-based Silicon Valley Bank, or SVB, and experts have claimed that one major cause of this closure is the high interest rate which has stifled operations of several financial institutions. The Federal Reserve has raised interest rates several times over the past 12 months. These higher rates have tightened credit conditions, making it harder for financial institutions to fund themselves, while also damaging the value of their existing loans and assets. The Federal Reserve has emerged as a leading force in the stock market, and these higher rates can weigh on publicly traded companies, particularly growth stocks like Tesla. Hello, everybody, and welcome back to Tesla Tomorrow. The Fed reacted to hotter-than-expected inflation with 7 interest rate hikes in 2022. However, stock experts and investors like Cathie Wood do not seem to be having it. Wood stated that if the Fed continues to focus on lagging indicators like the Consumer Price Index, or CPI, and does not pivot in response to the deflationary forces telegraphed by the inverted yield curve, then this crisis will devour more regional banks and further centralize, if not nationalize, the U.S. banking system. Cathie Wood believes that the Fed may be making a big mistake by tackling inflation this way, adding that the institution may be overlooking some important data in the process. Why has Cathie Wood said this? Let's find out. But before we start, if you like this type of content, make sure to hit that like button, subscribe to our channel, and turn on notifications to stay up to date on everything happening with Tesla. This is not the first time Cathie Wood is speaking against interest hikes by the Fed. Last year, the U.S. Central Bank announced a third consecutive 0.75% point rate hike, bringing interest rates to a range of 3% to 3.25%, the highest it has been since 2008. Although interest rate increases typically come in 25 basis point increments, the Fed seemed to be taking drastic action to reduce the inflation rate, which was well above its benchmark target of 2%. Reacting to this, Wood has said that while the Fed may see this as an effective method to combat inflation, the results of this action may have serious detrimental effects on the economy. According to her, the Fed seems focused on 2 variables, downstream inflation and employment, both of which she believes are lagging indicators, sending conflicting signals and calling into question the Fed's unanimous call for higher interest rates. Although the Fed claims that its strategy is sensitive to data, that is not what most financial experts like Cathie Wood believe, and they may be right. But first, let's see how it all started. Significant repricing occurred in the stock market beginning in 2022, and the S&P 500 stock index, a key indicator for U.S. equities, slipped into a bear market, representing a decline of 20% from its peak value, as did other major market indices. In response, the Federal Reserve sought to ease the inflation threat through its monetary policy moves. These measures included dramatic increases in the short-term target federal funds rate from near 0% to 4.5% and then 4.75% by February 2023, and also reduced its bond holdings. The Fed's moves are designated to slow the rate of economic growth, ideally without pushing the economy into recession. By increasing interest rates, the central bank plans to discourage spending, which can reduce inflation on the price of goods and services. However, there are other consequences to this, such as an increase in home equity loans up to 8%, a possible increase in monthly payments for new mortgages, and, very important, its effect on the stock market. But how do interest rate hikes affect the stock market, and particularly Tesla's stock? We'll get into that in just a second. When the Federal Open Market Committee, or FOMC, changes the interest rate, it impacts both the economy and the stock markets, because borrowing becomes either more or less expensive for individuals and businesses. While it usually takes at least 12 months for a change in the interest rate to have a widespread economic impact, the stock market's response to a change is often more immediate. Markets will often attempt to price in future expectations of rate hikes and anticipate that the actions of the FOMC are made official. The interest rate that impacts the stock market is the federal funds rate, which is the interest rate that depository institutions such as banks, savings and loans, and credit unions charge each other for overnight loans. And so, by increasing the federal funds rate, the Fed is effectively attempting to shrink the supply of money available for making purchases. As rates rise, businesses are not impacted by higher borrowing costs, but they are also exposed to the adverse effects of lagging consumer demand, and these two factors can weigh on earnings and stock prices. On the other hand, when the economy is slowing, the Federal Reserve cuts the federal funds rate to stimulate financial activity, and so a decrease in interest rates has the opposite effect of a rate hike, serving as a catalyst for growth, which in turn leads to greater profits and a robust economy. The Fed has constantly stated that it is dedicated to lowering inflation rates as much as it can. However, a combination of rising interest rates and a persistent surge in the inflation rate have heavy consequences on investment markets, stocks included. Aside from Cathie Wood, other stock experts have also reacted to the hike in interest rates by the Fed. Paul Nolte, portfolio manager at Kingsview Investment Management, Chicago, stated that the Fed commentary was pretty hawkish, adding that the rise in price is an indication that the markets are volatile and we will see a much higher chance of a recession over the coming months. Chief market strategist at Carson Group Omaha, Ryan Dietrich, also said that the Fed has not only left the door wide open for even more rate hikes, but is also willing to produce a good deal of pain to the economy and potentially to the stock market in order to rein in runaway inflation. According to Dietrich, the economic expectations from the Fed are quite disappointing, and the economy is slowing quickly. He added that the Fed's stance on interest rates could cause the dollar to move higher, pressuring stocks once again. On the other hand, the Fed does not seem to be giving up on its quest anytime soon. According to Federal Reserve Chairman Jerome Powell, the institution is bent on keeping its stance until it is sure that inflation rates are going down. He stated that inflation is running too high, and that one thing investors need to know is that the firm is committed to getting to a meaningfully restrictive stance of policy and staying there until he feels it is confident that inflation is coming down. Several other Fed officials have also said that they need to see sequential months of inflation moving towards 2% before there can be any discussion on easing the policy. San Francisco Fed President Mary Daly spoke about this in an interview, stating that there would be more policy adjustments required to restrain the economy sufficiently, and she sees the Fed raising rates to a level that it believes is restrictive enough to bring inflation down and holding it there. Likewise, Fed Governor Christopher Waller has also confirmed that until the Fed sees any signs of inflation beginning to moderate, it is not going to pause. While the Fed's current target range for its benchmark rate is 3% to 3.25%, it is still working towards a goal of quickly raising its benchmark interest rate to around 4.5%. Its officials have said that it would take a lot to push them off this path, and that the Fed is prepared to go higher if the elevated inflation rates fail to show signs of easing after this. In a recent tweet, Cathie Wood stated that several banks didn't expect the Fed fund rates to surge to record-breaking 19-fold to 4.75% in less than a year, and now deposit outflows are forcing these banks to sell safe securities at losses. Wood further stated that, just like in Silicon Valley Bank, startups are responding to a drought in venture capital funding by draining deposits to fund their operations. Although Wood believes that the economy is plunging significantly due to inflation, the financial expert also supports the idea that companies are likely to suffer the hit of deflation, and this is a problem that investors should be worried about. No doubt, inflation is hitting hard on the economy, but this time it is not a result of the regular factors, but a product of major economic shocks that have never been seen before. Do you think the Fed could announce another hike in interest rates anytime soon? Let us know your thoughts in the comments section. If you would like to know what Tesla has been up to these past few days, go ahead and click on the next video on your screen. See you there.